name is Manali Shah, and today's conversation is going to be all about startups. Joining us is Vinod Kumar, the founder of Naturally Yours, a healthy noodles and pasta brand. Vinod holds an MBA from the Cardiff Business School in the UK. He has over 14 years of experience in marketing, sales, and leading new business launches. Prior to this, he served in leadership positions at InnoServe, which has now been sold to Amazon. And you mentioned that you've been bootstrapped. So, naturally, yours has been bootstrapped through and through. And in my opinion, today there's a popular notion that to be a successful, profitable D2C brand, you do need funding, whether it's angel funding or, so on and so forth. Now, what would you say to that in the sense that how have you managed to sustain your business while being bootstrapped?
So a couple of things, right? So it's a conscious decision to be bootstrapped. Not saying that funded companies are bad or that path is wrong. That's completely an entrepreneur's call, right?
Yeah.
Now, being bootstrapped allowed us to do a lot of things that's right for our brand and for our customer. For example, it allowed us to focus in only one category. We will not do 10 different categories and see what works. We know this works. We go deep down. Like for example, the range of noodles and pasta that we have, no other brand in this country, in the entire of India, has. Probably even in the US, no other brand has that kind of range. Now that has been developed. Those products have been developed not just basis of our whims and fancies. It has been developed basis our feedback from our customers. Customers came back and said, "Hey, we want. I love quinoa, but I'm not able to have quinoa. Why don't you make a quinoa noodles for us?" Or customers have come back and said, your noodles are great, but we want gluten-free based noodles. Can you make something in that space? So it has come from that deep knowledge that we have had, and D2C allows us to do that. But as a brand, so we look at our business as a brand, not a specific channel. Right? When you say D2C, you put yourself in a particular box saying that D2C. And to be honest, no brand in India can be D2C. A lot of people say that they're D2C, but no brand in India can survive as a D2C brand after a certain revenue level. Of course, they will have a certain revenue level, but beyond that, you cannot survive you cannot just do online. The reason is Indian market is not yet that big for brands to become, let's say, a 500 crore brand or a 1,000 crore brand just online. They will have to have a huge mix of offline to come with online. Yeah, online you could lead online, and then you could go offline, because that's exactly what we are doing. Right? We have been online, and our online gives us huge amount of data in terms of consumer insights. Let's say, for example, in North, you would typically think that Delhi is one of the biggest markets for our noodles and pasta, and that is what we thought. But here is a very interesting fact that Lucknow is one of the fastest growing region for us in terms of demand for our noodles and pasta. So if I want to start, let's say, a distribution channel in North, it should start in Lucknow, because that's where there is a huge demand growth coming. So these are the insights that a brand should use and then move on to that. And being bootstrapped helped us to crack our, we know our unit economics. If somebody says that, hey, this is the kind of margin I want, we can, myself and my co-founder, we can do a back of envelope calculation and straight away see whether it works for us or no. Right? We don't need, exhaustive Excel, or we don't need all of that, because we know exactly at what point we make money, at what point we do not make money. And we track that every single day, whether it is online or offline. So we know those numbers. So knowing those numbers are super important when you're bootstrapped, right? When you have a lot of funds in your pocket and you are just going for growth, you may not necessarily need all of those things. You may not necessarily look at those things. But for us, those points are fundamentally very important as a brand. Right, so that's what bootstrapping and being a brand in bootstrapped D2C, if you want to put it that way, makes that's how we look at it.
Wonderful. That's great insight and something that possibly every entrepreneur who's looking to be bootstrapped should keep in mind. And any schemes that they should keep in mind while they are bootstrapped. Some ways to just keep the cash flow smooth, running smooth.
Oh, there are tons of it. First, a lot of time what happens is this happened with us also, right? When you bootstrap, you're thinking, "Arey, who will fund me? How will I fund my this growth? How will I grow on Amazon? How will I buy?" Let's say you have to pay in advance sometimes, right? Because nobody believes you. So how do I do that? There are tons of ways you can actually raise money in terms of debt, right? But for debt, primarily your balance sheet should be good and your P&L should be good to a certain extent. In the sense that you should definitely be profitable, and the
Right.
and your cash should be coming in, even if it is negative at the initial stages. It should be coming in. So those are the kind of businesses that get kind of debt fund. Now, one of the best way for D2C brands to raise is something called as a revenue based financing, RBF, right? In industry they call it RBF. So revenue based financing helps you to bridge that gap of growth and inventory funding, right? So basis your revenue, you get funded a certain amount of money. Let's say your revenue is 20 lakhs per month, you can get funding as much as 10 lakhs as loan,
Okay.
which you'll have to repay back in 7 months at about 12% rate. And
Okay.
that loan amount is taken away from your bank account every single day. So it is not like
Mm-hmm.
EMI जैसा चलता रहेगा वैसा नहीं. Every
Right.
single day 2,000, 3,000, and let's say your revenue goes up, you pay more. Your revenue comes down, you pay less. So your cash flow is
Mm-hmm.
also not significantly hurt, and that's a
Okay.
great discovery that we have had. The paperwork is not too much on something like that. You can easily
Mm-hmm.
get it, and this is all without any collateral.
Okay.
The second way you can raise is your typical ODCC. The third thing that you can do is
For
do an
just
MSME.
to elaborate on
Yeah,
that
yeah, good.
for very young founders or aspiring founders who may not know these terms, if you can
Yeah.
just go into a little more detail.
Okay, so an OD is an overdraft account. Okay, overdraft or cash credit account. An OD account basically you will get with most government banks. You will get it. Private banks usually do not give it to a startup, right? If you're 1 year in, you will easily get an ODCC account with any of this the government banks under a lot of schemes. One of the scheme is called as CGTSME, right? So this is a government of India scheme specifically for MSME, right? That is the
Mm-hmm.
micro, small, medium enterprises. Now, under MSME, you will have to first get yourself registered in MSME, which takes about
Right.
like a couple of hours to get an MSME certificate. You can do it online yourself. We did it online ourselves, right? You
Great.
don't need to go to any agent or anything. You just need to go online. Within like half an hour, 45 minutes, you can get things done, max 2 hours, right? And once you have that, you go to any of the public sector bank, or you go to banks like IDBI and tell them that I need a loan under CGTS scheme. So the government of India gives up to 2 crores to small medium enterprises under this scheme, which is collateral free, and the interest rates are anywhere between 8 to 14%. Right?
Okay.
So this is a great thing that not many people know, but this is something that you could utilize in the initial stages, right? So again, this is a debt funding. So debt,
Right.
in my view, debt is always way cheaper than equity. A lot of times
Mm-hmm.
as founders, we say that यार मेरे equity का value क्या है, तो equity ले लो, give me money, but they do not explore this. Now, third way is something of an asset based, right? Let's say if you or let's say a founder has worked for some years and he has invested in shares and mutual funds and all of that, right? He can leverage those mutual funds or those shares, give it to banks as a collateral, and leverage that. Like for example, there's something called as LAS, right? Loan against shares.
Mm-hmm.
Let's say and any bank will give you, right? Let's say an ICICI, HDFC, any of them will give
Right.
you at a very low interest rate. At an interest rate of 8 to 9%, you will get up to 20 lakhs under LAS, right? But if you have, that's an asset, underlining asset.
Right.
I think that is something that you should go for last if you do not have any of these things. But these
Right.
first two things, definitely you should explore and you should do something there.
Let's also talk about funding a little bit, in the same vein. So let's say a startup is looking to get funded. When is the right time?
See, there's no right time or this thing. You can get seed funding. There are plenty of angels, right?
Mm-hmm.
But I would say the best way to get funding is to start with some. Don't just go at an idea level. Especially, I'm when I'm talking about funding, I'm talking about the food space or the food and the beverage space, right?
Mm-hmm.
I have no idea about how fashion works. I have no idea about other categories.
Right.
Because I have been through and through doing food businesses, I can tell you this for a fact that the great thing about food businesses, you can validate your idea very quickly, right? You can start your website, you can do a bit of advertisement at a very minimal price. You can understand whether there is a market or no. And once you
Mm-hmm.
have that data, that will get you a lot of confidence when you go in front of an investor and say, hey, you know what, this is what I found, this is what I think is the future, and this is what I think I can grow my company to. And that's when an investor probably might also be interested. But it should be a big enough problem to solve. If it is a very niche problem, most investors are risk averse that way. But I feel it's a very counterintuitive thing, right? But most brands get built when they're always in a niche, and then they go on to become broad. No brands
Yeah.
start broad and then go on to do niche, right?
Right.
So that's something that when you're starting off, I'm going to this thing, validate your idea with customers for
Mm-hmm.
sure, and know your numbers. Know your numbers through and through, because if you don't know your numbers, forget about the investor, you wouldn't be able to run your business beyond a certain point, right? So
Right.
you should know your numbers, especially in terms of what your margins are
Mm.
and what are the variable costs and all of those things. You should definitely know those numbers.
Okay. And what are the checks and balances a startup should ensure while looking to raise funds? What should they have in place?
Uh, so don't dilute too much too fast, right? Try to do the initial first 6 months via bootstrapping, because the experience that you gain via bootstrapping will be phenomenally high than when you have money. Because when you have money, what happens is, right, you can easily throw money at problems. But when you're bootstrapped, you are constrained for money every single day. So you have to think of ways in which you have to do with far lesser. Like for example, you have to probably get in tech, right? At a very early stage, you have
Yeah.
to get in tech, and that also tech which is not very expensive, and that boost your businesses. Like we have included so much tech in our business, and we are using all of those at a fraction of cost, which a competitor of which one of our competitors are using. They're spending tons of money on that. We're doing at a fraction of the size, right? One of our competitor, I know, they have spent probably 20-30x the money to get to the same revenue that we had, right? So those are the wrong things that you will do when you have money.
Mm-hmm.
So you raise a small round initially, validate your idea, and don't dilute too much too fast. Even if you're looking at great brands, if you want to have an example of huge brands like Boat, right? They did not raise huge amount of funds. Now the
Yeah.
founders have over 50% plus stake when they're going to IPO, and that's a huge success story that they will have. So
Right.
that's a founder first success story, not an investor first success story, right? As a founder, I will back founders only, but that's
Of
how
course.
I think that's how they should think if they're going for funding.